first time with us, we really appreciate you joining us. And of course, those of you who we know already, thank you for coming back and welcome. It's great to see you all. Before I introduce our key speaker of the evening, I'd like to introduce a special guest of ours, a very special guest. You may know him from mornings on WATV, where this is his 35th year on the air. And he's been gracious enough to come and say a few words. Ladies and gentlemen, Mr. Bobby Gunther Walsh.
I was gracious enough, I'm thankful enough. Seriously, that's why I'm here. I'm here because Don Hunter, he's such a great friend, such a great advertiser, such a great sponsor, and he's produced results for me, and I do this out of thankfulness, not because I'm kind enough. It's because he's been kind enough to me. Really, he's a great person, has done a great job selling my daughter's house, selling my house, finding us a new house. His construction team helped fix up the new house, and he was willing to partner with my other advertisers. It was a great project, and everything he has ever promised me, he's delivered on, and then some. Whether it's been guaranteed to sell your house in 68 days, I begged him not to sell mine so fast because I wasn't ready to move, and he sold it too fast. Damn it. Or whether it's delivering, as for me, 10% on my money with DLP Capital Partners. He's a man of his word, a man of integrity, and that's getting harder and harder to find these days. I'm honored to be associated with him here out of a sense of respect for what he's done for me, to introduce Don Hunter, DLP Capital Partners.
Thank you, sir. Thank you. Good evening, everybody. Thank you, Gunther. All right, so we're going to get started. I'm told dinner is going to start coming out any second, so feel free to eat as we go through here, a little presentation, tell you a little bit more if you haven't been here before about us, and if you've been here before, tell you a little bit more about the updates that are going on here. So let me get this PowerPoint here working. Hang on. Kate, might need you here. Let's see here. All right, so while our IT team gets our computer working here, I want to go ahead and ask our existing investors, who are all wearing a red name tag, I believe, to go ahead and stand up. So more than half the room are current, active, hopefully happy, especially after they get dinner, investors of ours. So round of applause to yourselves, to our current investors. So we did this completely by accident. We have existing investors sitting next to you as prospective investors. It was completely by accident. We don't expect them to tell you anything about us or try to convince you to invest at all. So appreciate that. Thank you guys for coming out, showing your support. I know many of you have been here many times, know a lot about us, and come out more than anything to show your support. And then I'd like to also ask our DLP team members to stand up. So these are all the people who make everything happen here at DLP. So also they're sitting at your tables by mistake as well. So feel free to chat with them. They're the people who make everything happen. I just get to do the fun job of telling you about what we do. So what I'm going to talk to you about today is a little bit about our history, how we got started, what we do, and why you should be interested in how you could participate in what we do. So we're an investment management firm, as hopefully you know by being here today. And when you look at investing in any manager and any strategy, whether it's real estate or otherwise, the way I look at it is there's two things that are really, really important in making a good investment. One is the strategy you invest in, and two is the ability to execute on that strategy, which in many cases is the manager or the advisor you're entrusting your money to, ability to execute on whatever that strategy is. So our strategy is real estate. Specifically, it's making private direct loans to real estate investors and buying real estate direct. And we, DLP Capital Partners, are the manager who's able to execute on the strategy. We're going to tell you how we do that here tonight. So again, we do direct lending to real estate investors, and we buy mainly apartment buildings, apartment communities, Class B apartment communities And I'm going to tell you a little bit about both of these strategies here tonight. A quick little bit about us. We're a vertically integrated operator. So as Gunther told you a little bit about, we have a real estate brokerage called DLP Realty, property management, lending, construction management, etc. We have over 290 team members, about 30 or 40 of which are here with us tonight, who make what we do happen. And we operate a system here we call at DLP called the DLP Elite Execution System, which is how we drive performance across our companies that I'll tell you a little bit about tonight. But I'll start off with why you should be interested in what I'm going to talk about, other than that I'm buying you dinner tonight. So first are the returns. So you have basically two ways to invest with us. One is you can invest as a fixed return investor like Gunther and earn a fixed return of 6 to 9%, and we have different incentives we run at different times. We can earn even higher than 9% fixed return on your investment. That's fixed, guaranteed by us, not the FDIC, locked in return with monthly distributions. Or you can invest in as an equity investor in our funds. We have 3 different funds, each one slightly different, but all of them produce over 11% annual returns, each of our investment funds. So those are the financial reasons and the return reasons that hopefully pique your interest. The other reasons to think about investing with us are these questions here, are these potential reasons to be thinking about investing with us. So hopefully, if you're here tonight, at least one of these reasons will resonate with you. So you have a family that you want to be able to provide security to now and in the future. You're interested in retirement, you are in retirement, and you want consistent, stable income you can count on to live the lifestyle you want to live. You're planning for retirement and want to have consistent investment growth so that when you do retire, you have enough money to provide you the comfortable lifestyle you're looking for. You have concerns about the economy and you want to protect your investment from the changing market conditions ahead. Or fifth, you'd like to have a good night's sleep. As many people have asked me tonight, how does the stock market affect us? It doesn't. The ups and downs that have been going on do not affect our day-to-day world, and our investors who entrust us aren't worrying and stressing and paying attention to that every single day. So those are the reasons you should be interested in investing with us. Hopefully at least one of those reasons resonates with your situation, and why we think our strategies are pretty unique and can be pretty beneficial to most. So our philosophies here, how we think about investing, although I just told you about how great our returns are and what we pay our investors, we have a few rules that drive what we do here and how we think about investing. So the first one is do not lose money ever, period. So that's our first principle. Although we try to generate as high of returns as we can, that's what really drives our decision making first. We can't take risk of our investors' money. Second is we have to be able to generate really consistent returns. So not only generating good returns, but making sure they're very consistent. You know what the return is going to be. You're going to get it on a consistent basis. It's not going to be 1 month, it's a really good return, next month not so good. So you can count on it, you can plan your life based on the return. And then the third thing we really focus on doing is generating as high of a return as we can while making sure our returns are consistent and we're not risking your money. And we're really proud that we've not only stated these as our goals, but we've lived these goals now over 12 years. We live these principles. We've had 0 losses to any investors ever, and we've generated really, really consistent high yield returns now for many, many years. So what we do here at DLP, how we go about doing that, is we invest in people and in real estate. And when we say we, I'm certainly talking about myself and the 290 plus team members, but I'm also talking about all of you. So it's your money along with ours that's being invested in people and in real estate. So what that means is we provide right now affordable housing to more than 20,000 people. I believe it's 22,000 people right now that are living in the properties that we own along with you, that are providing safe, affordable places to live. We're currently supporting more than 200 entrepreneurs in their businesses, helping provide income in their markets, their local markets, providing jobs, driving local economies. We provide jobs to about 300 team members and their families here locally. Over 100 of our team members are right here in the Lehigh Valley, throughout St. Augustine, Florida, where we have a Southeast headquarters, and throughout many of the markets we're in. We're in 10 states right now that we have team members in and we operate within. And then we generate, in turn, by doing those things, we generate consistent, reliable, high yield returns. And these are some pictures of what we generate. So these are, the top right is a picture of our team a couple years ago, I think now, in front of our Bethlehem office. Down at the bottom right is at our Florida Christmas party a couple weeks ago. We had an ugly sweater party. You'll see some pictures of a few of our apartment communities and homes that we own right now. Some pictures of some happy clients that we help buy or sell homes or provided them with loans. So those are things we do each day. So these are the family of companies at DLP. These are all the different companies that operate together to generate these returns, from, again, real estate brokerage to lending to property management to construction to, of course, DLP Capital Partners, our investment management firm. These are the smiling faces who drive our results. This is our executive team. You'll see a few of them here today. Executive team, whichever executives are here, go ahead and stand up. I saw Amy just a second ago over here somewhere. So executive team members, we have a few of them around here. There we go. So those are some of the executive team members who really drive incredible results. So Amy, Matt, and Nate, all here. So a little bit about myself. If you haven't been here before or don't know much about me yet, I've been in real estate now for 13 years. Over these past 13 years, I've closed over 9,000 real estate transactions for over $1.25 billion, including having purchased more than 10,000 homes or 11,000 homes and apartments now. Ranked as one of the top 15 real estate professionals in the U.S. for 4 straight years by the Wall Street Journal. And I am the founder and CEO of each of our family of companies. As I believe I said a little bit earlier, we now own over 9,000 homes and apartments along with you as our investors, up from about 5,000 just at the start of this past year. So pretty amazing growth. And thank you to all of you as our investors who drove that result. At DLP, if you haven't yet learned this, stands for Dream, Live, Prosper. Our purpose is to passionately creating prosperity through real estate. That's really what we focus on doing. These are our 8 core values that drive our results, our hiring, our decision making throughout our organization. And everything we do revolves around solving problems, creating solutions for people through real estate. And I'm a big believer that what great companies do is they solve problems. And that's something we've really been focused on doing for a long time here. Every company we have today, everything we do came and stemmed from us looking to solve problems. And many of you, as I could tell from your round of applause for Gunther, have been hearing us on WAB, on Gunther's show, for a long time. And he's been talking about us on there for 9 or 10 years now, I believe. And one of the messages we talk a lot about on there is our immediate buyout program. And I was going to, for the first time ever, play a live commercial here so those who haven't heard it could know what we're talking about. But I decided instead, why not just actually have a real live commercial and I'll let Gunther say what he says on the radio.
Don, before I do that commercial, I'll tell you that one of the people he uses and provides jobs to is Rick Zambora.
Yes.
When I got to my give a round of applause. Rick Zambora, great guy. I moved into the new house, and I don't know what was we had a problem with the furnace, and I said, I don't really have a guy. He said, I'll send a guy over. And it was Rick Zambora, so providing jobs for the local people, and that's how I ended up actually endorsing Rick. And the 2 things I do talk about Don Leonard is where other people see obstacles, he sees opportunities. And where other people see problems, he finds possibilities. And that's what he's done for me and countless others. And one of he's got the sold in 34 days now. He's also got I Buy For You, which is an incredible program. And the immediate buyout offer. Here's the way the immediate buyout offer works. One of his people comes over, or Don himself, whatever comes over, looks at your house. In 24 hours, you have a cash offer on your house. And you can close it as fast as 7 days. It usually averages around 10 days to close it. You pay no closing costs and no commissions. There's no contingencies. You don't have to show the house. You don't have to make any improvements to the house. And you're closing in 10 days. When you figure out what you're saving in commission and what you're saving in any closing costs and any improvements you might have to make, the offer is a really solid offer and a really competitive offer. And for people that don't want to clean out a loved one's house, you say, well, I really want to do this, but I'm not going to be able to clean the house. He goes, we'll clean it. I mean, that's solving problems. So that's the immediate buyout offer. 484-366-1213. That's 484-366-1213 or DLPsold.com.
Thank you, Gunther. So that program Gunther talked about, our immediate buyout program, that's how we bought over 1,000 homes, have been through marketing that program. And very often we're buying homes of people moving into senior housing or loved one passed away, etc. But we've also, through that program, had a lot of real estate investors contact us, including many people in this room tonight. And this picture of this house here is a property in Slatington, Pennsylvania. And this goes back probably close to when I started with Gunther, maybe about 9 years ago. The gentleman who owned this property, his name's Paul Horner, a wonderful guy. And so Paul called me, and Paul's got an amazing story. Paul was a lifelong janitor in the Slatington area. And basically every year or two, he'd go out and buy another rental property. And he steadily built up a portfolio of a few $1 million in real estate off a janitor's salary. So he built up this portfolio in Slatington, and he came to me and said, Don, you know, I've been hearing you on the radio for a while, and I'm really worried about leaving all these properties to my wife and my kids. You know, they don't have the ability to manage these properties and take care of them, but I'm also don't really want to, you know, sell them and then not be able to have income to provide, to support, you know, their lifestyle and so forth. So what we did is we stepped in, which we've done with many investors, and we bought this property on Diamond Street in Slatington. And then Paul actually invested that money with us and ended up earning as good or better of a return on his money. And this really, these types of solutions, this immediate buyout program is how we became a real estate investor and how we became an investment manager. It wasn't that we set out saying we're going to start flipping houses. We set out and said we're going to provide solutions. And we realized a lot of people couldn't go through the way of selling your home through a traditional way. And then people coming to us saying, I don't know what to do with the money once you buy my property, started our launch of offering investment opportunities. So now Paul's still an investor of ours after 8 or 9 years. He sold all of his properties to us. And we bought, I think, 42 homes and apartments from him. And he's invested most of that money back with us. And there's some other investors in this room who've done that. And interestingly enough, I didn't plan this when I had this story, but the gentleman here to my right is going to be buying most of those properties from me here shortly to build his real estate portfolio. Great example, and Paul's been one of our long-term investors who really is how we started out, and it's kind of how we got to where we are today, in both as a real estate investor and as an investment manager, a fund manager. We've sort of been able to connect the dots between opportunities as an active real estate investor and being able to provide opportunities to investors to invest passively through us or with us. So great example of how kind of we've started and how we got to where we are today, which I'm going to tell you a little bit about. So again, as I said earlier, we've had 0 months of ever missing our returns to our investors. We've had 0 losses to any investors. And we've generated double-digit returns on all of our equity offerings every year, every period. And we've been paying out 6 to 10, 11% fixed returns to investors now for going on 9 or 10 years. Paul was one of our very first investors. As we've grown and as we've paid out these great returns to you guys, one of the reasons we have been able to do that is because we've been able to continue to grow as a company really consistently. We've been one of the 5,000 fastest growing companies in America for 6 straight years. We were the 10th fastest growing company in America in all industries who made this list 5 or more times ever. So very few companies maintain the consistency of growth that we've been able to maintain, and that's why our returns have been so consistent. So we started from the stories of buying a 4-unit apartment building from Paul Horner to now to what you see there on the screen today. So right now we have over 500 investors in our funds. This past year we've sold over 1,200 homes. We currently have outstanding loans to real estate investors, over 300 of them. We own over 9,000 apartments and homes. We have over $600 million in assets. We have over $100 million in annual revenue. As I mentioned earlier, we provide housing to more than 20,000 people. And we have over 290 team members here in the DLP family of companies. So that's where we're at today, where we've grown to over the past over a decade. You might be thinking, why are you here then if we've done all this already? because we're still growing. So here's our targets for 2025, which I promise you, if this is going to be here before we know it, we're going to blink and it's going to be 2025. We're going to have over $1 billion in capital under management. That means investor capital in our funds. We'll own over $1 billion in real estate and over $1 billion in loans. So we're still steadily marching and growing over the next number of years, even as the market goes through changes and down cycles, which it will go through over this between now and 2025, I promise you. So a little bit about DLP Capital Partners. I have 2 partners at DLP Capital Partners, Bob Peterson, our CFO, and Barry DeGroot, our general counsel. They're both owners in DLP Capital along with myself. We allow you to be able to invest through most of the major brokerage custodial platforms. The main one we work with is Charles Schwab. We can work with many of them. We now have many RIAs and wealth managers who invest their clients' money with us as well. We're headquartered right down the street from here at 701 West Broad Street in Bethlehem, although we will be moving to 95 Highland Street across from Wegmans on 512 this quarter. We're really excited about that. We also have a southeast headquarters in St. Augustine, Florida. Who here's been to St. Augustine, Florida? Wow, more than I would have thought. Awesome. Oldest city in America. If you haven't been there yet, come down and visit us. And then we have 3 other offices in Florida and here in Pennsylvania. We have, as I said earlier, over 500 investors, many of which are in multiple investment funds with us, many of which have now been with us for many years. We operate in all of these states in green. I know you can't read that, but those states in greens are the states that we are approved to do business in. Some of those states we have not yet done business in. We've done business, though, in 24 states. We've made loans in, and we own properties right now in 10 states. This is, I know, hard to read for you, but this is in your brochure as well. All those little reddish icons you can see there are all the apartment communities we own. So you'll see that it's heavily in the southeast, Florida, Georgia, South Carolina, North Carolina, as well as Mississippi, Alabama, and Louisiana. We just bought a property up at that very top there in South Bend, Indiana, 739 apartments. About 4 days ago we bought that property, our first acquisition in Indiana. And then of course we own a lot of properties here in Pennsylvania as well. So why should you be interested in investing in us? So above and beyond the great returns and so forth we talked about, one of the things we really pride ourselves here is transparency. So if you have not yet been on this website, we have a website called DLP Crowd, where if you're an existing investor, I'm sure you're very familiar with the site, but even as a prospective investor, you can log into this site. You can see all of our historical returns, our actual financial statements, our actual assets, our audits by our third-party auditors, everything you could want to see to get to know us and get comfortable with our investments. So I'm going to bring up an investor. Before I tell you about the 2 funds, which I'm going to do next, or our 2 strategies, I'm going to bring up one of our investors here to tell you a little bit about his experience and tell you his perspective on us as an investment firm, and then I'll explain a little bit about our strategy. So come on up here, George. So a round of applause for George Miller. Thank you. All right, George. So how long have you been invested with us?
I am now going into my 3rd year.
Awesome. Well, and which funds are you invested in?
I am in the income and growth fund because I happen to like both of those words.
And so you like the words, but what has that fund done for you? What made you choose that fund over the other strategies, if you can remember?
Again, I like income. I like growth. So part of what I do with it is take some of the income and I leave some of it in as compounding, which takes care of the growth portion of it.
Awesome. So to give a little more color, so George's been in that fund for about 3 years. It's been producing 12.5% annual returns. So he literally has the ability, we can do this for any of our investors, where he says, I want X amount of money each month to play with or live on or do whatever the case with, and then have the rest reinvest and grow. So you can choose to have all the money distributed every month, you can choose to have all of it reinvest, or you can do a combination of both like George does, which is a great way to make the investment supplement your lifestyle. So awesome. So with you standing up here and you have this room full of investors, for any of these investors here thinking about investing with us, what would you tell them?
I would first probably tell them the strategy I went through to become an investor. I think I first crossed with Don when he was doing an immediate sale on a house for me. And very similar to Bobby Gunther. I knocked it out very quickly. We had a couple of things going at that time. It was a time issue. And as I watched the process evolve, I said, hey, maybe I better take a look at this bigger picture here. So having been in the car business many years, I learned that when you loan somebody money, there's 3 C's you want to check out. Character, collateral. Third one is the ability to, let's call it, payout capacity. I met with Don probably for an hour, asked many questions, took the time to answer them. Probably half of them I knew what the answer should be. I wanted to hear what he had to say. Don got an A+ for that one. To make sure, I wanted to talk to a second person. I know he's in this room here somewhere. He came out to visit with me. That was Larry. Asked him some of the similar questions. Also got an A+. Second part of it was collateral, digging through the numbers, digging through talking to people. You're talking about someone who knows his business, who knows how to buy property, knows how to manage property, knows how to take care of property. So your collateral was there, it was safe, it was being preserved, it was being invested. A+ on collateral. We then went to the third C, capacity, the ability to pay out the numbers that you just saw up on the screen. Same thing. Little checking, a little talking, little observation. Yes, there's audits. Yes, it's transparent. Capacity was there. It's well funded. It's well run, it's a well-oiled machine. So he checked off the 3 C's. And I signed up.
Awesome.
Along the way, I added a 4th C called compatibility. Everything you saw up there, 100% accurate. The prize for me, the bonus, was the people. It's called the 4th C, compatibility. Everybody thinks the same, everybody is on the same page. You see how they're educated, and the fact that a problem is not a problem, it's an opportunity, that's a fact. That's how they think, that's how they work. That works from the top down. Don has no idea what I'm going to say here tonight. So it's coming from the heart. That's what I've seen. One of my favorite people growing up. I happen to be a very strong baseball fan. I'm sure everybody in this room is a Yankee fan. And I saw one handball. But my favorite is Yogi Berra. I've gotten to play golf with Yogi. I've gotten to spend cocktail hour, just he and I talked for an hour and a half. He wrote a book a few years back called You Can Observe a Lot by Watching. Okay? I've watched for into my 3rd year. I talk to the people at the dinners. I talk to the people who visit me in the building, from Larry and Bob. They're problem solvers, they're talkable people, they're compatible people. So the answer to your question, Don, what would I tell them? What are you waiting for?
Thank you very much. Thank you, George. Round of applause, awesome. And if you can guess, George and I did not meet for an hour. It was at least 3 hours. Appreciate that. Awesome, George. All right, so I'll tell you a little bit about the strategies you've been hearing us touch on a bit. So we have two things we do here when it comes to investing. The first is we make loans to real estate investors. So I'll give you the quick highlights on this strategy. We paid out over a 13% return every year, every month for going on 5 years now in this strategy. We pay out 100% of the distributions every month. You can redeem the investment in 90 days or less, so it's highly liquid for a private investment. It's a great way to mitigate risk from interest rates rising because that actually benefits us as we're making short-term loans, and if rates go up, we can increase our rates. Limited risk in real estate because we lend at very low loan to values, which I'll explain. We have over 45 professionals running this strategy. We have over 300 loans out right now. We on average deploy your money in 8 days. That's an important item. If you invest with us, we're going to have your money deployed, earning returns very fast. We've done over 1,000 loans with no losses to investors. We start paying you distributions every month. And then something interesting that most of you who've even been in this fund and all of our lending funds, our income and growth fund, the lending fund, and the fixed fund, that's a new tax rule, is this will actually qualify for a new tax deduction that'll give you a 20% reduction in the tax rate. So instead of paying ordinary income tax rate, you're going to get a 20% reduction. It's called the 199A qualified business income deduction. So you're going to get that nice benefit here in 2018 and moving forward in your K-1 statement, your tax return statement, of some tax relief. So what do? We make short-term loans, 6 to 12-month loans to real estate investors, such as the gentleman here to my right. These are bankable, successful real estate investors who are doing this full-time. Good news loans, meaning they're coming to us to buy a property to make money, not because they're in distress. We're lending against single-family homes and apartment communities. Those are the main two properties. Every now and then we'll lend on a commercial property, but mainly it's housing. Single-family homes and apartment communities. On average, we're lending against average single-family homes, such as this home here, Cape Cods and ranches, $200,000, $250,000 homes. On average, we're charging 12.2% interest rates. On average, we're lending 73% loan to cost, which I'll explain, and 54% loan to value. Then multifamily properties. We lend on the same type of apartment communities that we buy. 50-unit, 100-unit type apartment communities mainly. So if you were looking to borrow money, you would come to Direct Lending Partners, which is our lending side of our business. And we built a great reputation, and why investors are willing to pay us the interest rates they pay us and come back to us again and again and again, is we built a reputation of execution, experience, and efficiency. So they know when they come to us, it's going to be a smooth experience. It's not going to be like working with most banks. We're going to be able to move very fast, and they know they can count on us. We're going to show up on time with the money for them to close. They don't lose a deal. They don't lose their deposit, which, believe it or not, is hard to come by in the world of lending today. We also provide them with a lot of resources. So most of the investors we work with are guys who are building their real estate business. And the fact that we've done this, we own over 9,000 homes and apartments, actively buy real estate. We can provide them a lot of resources, contractors, vendors, knowledge, training, tools, etc. We lend to very strong borrowers. Our average borrower today has nearly a 700 credit score, has $3 million in net worth, has about $500,000 in liquidity, and has completed 25 real estate investments. So good quality bankable investors. These aren't people that are in distress and can't get a loan anywhere. Most of our borrowers, many of our borrowers, go to a bank once they finish the property to refinance out our loan. As a quick joke here, we do not lend to this person. It would be so easy to flip this house. So a lot of people think that, right? A lot of people watch HGTV and they make it look so easy. They use this thing called HGTV math, which tells you if you buy a house for 100 grand and you put 20,000 into it and you sell it for 150, you make 30 grand, right? Because there's no taxes, there's no insurance, there's no holding costs, there's no expenses, right? They make it look so easy. They get it done in a 20-minute episode. But it takes a lot of work. It's a full-time business. We lend to full-time professional investors who run contracting crews, etc. One of the biggest ways we mitigate risk in this strategy is through what we call loan to value and loan to cost. So our loan to value is 54% and our loan to cost is 73% on average. So on average, when somebody buys a house, who wants to take a guess at if you were going to go buy a home as a home buyer today, what's the amount of money you would typically put down on a home? You can shout it out. 20%? Any other guesses? No realtors in the room answer. Any other guesses besides 20%? 15? 10? 30? So today, the most common form of financing is called FHA financing, which is 96.5% financing, plus you can roll all your closing costs into the mortgage to get 102% of the purchase price. That's the most common source of financing. So in the last market downturn of 2008, there were over 10 million homes that went into foreclosure. Take a guess at, now after what I just told you, what percentage put 20% down? 0, 8, 1, 0.1%. Less than 10,000 of the homes that went into foreclosure put down 20%. So if you were a lender and you knew that the borrowers who put 20% down didn't go into foreclosure, but when people put hardly anything down, they had a much higher percentage, what would you think is important? Cash down, right? Skin in the game. We know that that's the most important factor in making a loan. Above everything else I'm going to tell you, when people have significant capital in a property, so think about it, our average loan's $185,000 on a single family home, so they're putting 27% out of their pocket, $60,000 or $70,000 out of their pocket into an average home. That's real money invested. They're not going to walk away from it. It's one of the biggest reasons we've had no losses and a very good track record of consistent payment by our borrowers. On average, all of our loans are short-term loans, which helps us mitigate the long-term risk of real estate market cycles. Our average loan pays off in under 9 months. That means a third of all the loans we have outstanding today will be paid off this quarter, which means we're going to have this quarter $40, $50 million worth of loans pay off, which means we have a lot of liquidity to be able to pay out to our investors because we're not making long-term loans. It'd be a lot easier for Nate, our president of lending, our lending team, to make a 5-year loan or a 10-year loan and just collect the payment every month versus having to re-underwrite and reevaluate a new loan every 8 months. But it helps us mitigate risk tremendously. Another way we mitigate risk is diversification. We have over 300 loans right now in more than 80 markets across 20 states to more than 50 borrowers right now. I know you probably can't read this, but these are all the different states we have loans in right now. Again, most of our loans are very short term. That dark blue on the right are the percentage of our loans that are 6-month loans. And most of the loans are against single family homes, with the second largest percentage being against multifamily properties. Another way we mitigate risk is every property, or 99% of the properties I should say we get a third party appraisal by an outside appraisal agency. We get a third party inspection done by an outside inspection agency who both go out and physically look at the property, take pictures, evaluate it. We do an internal valuation on the property. We do an internal review of the renovation and the construction work on every loan that we do. Another way we mitigate risk is through DLP. The fact that we are a vertically integrated operator who's flipped more than 1,200 homes, who's owned more than 500 rentals, who own more than 9,000 apartments, meaning if we make a loan to somebody, we had to step in and take back that property, or we had to come in and help finish that renovation, we can. We're not afraid to do it. We do it every day. We buy properties every day today in these same markets we're lending in. So we're able to step in and provide resources and finish a project if the borrower gets in trouble. This is a sample loan. This is what our typical loan looks like. This is kind of right down the middle of an average loan we do. It's a little ranch home in Tampa, Florida, 4-bedroom, 2-bathroom, 1,800 square foot house. This is what it looked like at the beginning. Dated kitchen, gutted bathroom, missing drywall, need of a decent sized renovation. This borrower came to us, and I show this loan because it's on the higher end risk per se of what we do, in that it's 85% loan to cost, 70% loan to value, which are the maxes we do. But this borrower had a 785 credit score, which is a better credit score than many of us have. It's a great credit score. We did a loan for $168,000 against a property we valued at $240,000. It's a 12% interest rate. And this is what the home looked like at the end, completely renovated top to bottom. And again, most of our investors are professional investors doing a high quality job like you can see in these pictures. And she sold this property, oops, I'm missing the last slide, but she sold this property in about 6 months for more than what we valued it at, which is typically what happens. This here, I know you won't be able to read this, but this is in your brochures. This is showing our quarterly and monthly returns for the lending fund since we started. What you can see is that that light green color is the target return, which is 11%. That's our targeted annual return. The dark green shows you how much we've exceeded that return by every single period since the fund's been open, at a 14.3% annualized return since we opened this fund, net to investors. Again, some of you won't be able to read this, but the quick highlights here are when you invest in this fund, the targeted return is 11% return. You have a 10% preferred return, which means you earn 10% before we earn anything. You can redeem your investment in just 90-day notice. We pay out 100% of the distributions every month. And again, you have incredible liquidity, double-digit returns with monthly distributions. Or like George said, you can reinvest that money or do a combination of both. You can also, in this strategy, invest as a note holder. So this is what Bobby Gunther Walsh talked about. You can invest in your money at a fixed return. So based on how long you choose to invest, you can choose to commit your money for just 90 days, 3 years, or 5 years. And then based on the amount of money you invest, you're going to get a fixed return ranging from 6 to 9% fixed return, again with monthly distributions or the option to reinvest. This next chart shows if you chose to reinvest what your effective return is, because we compound every month. So this says here, and you can utilize your IRA, and this says if you can't read it, it's not all bad. I've crunched the numbers and figure you can retire when you're 238. So it's a great strategy to invest if you're looking to plan for retirement, invest IRA money. When you can plan that, hey, I'm looking to have access to the money in 5 years or 10 years, and you can do the math on a calculator very, very, very easily and say, I'm going to have exactly this amount of money in 5 years, 6 years, 7 years. That's a pretty great feeling to be able to project that out, because our returns are fixed. You know exactly how much money you're going to have in a month, 3 months, a year, 2 years, etc. So it gives you great consistency. So that's strategy number one. The second strategy, which I'll go through fairly quickly here, is our multifamily investment strategy. So who likes giving Uncle Sam a lot of their income? Nobody for that one? So this is a great strategy. In all seriousness, if you're looking to shelter your income from tax, this is a great strategy to look at. So what we're doing here is we're buying apartment communities, like that picture you see right there. We're buying 200 to 500 unit apartment communities, mainly what we call Class B, which I'll explain. These are some pictures of the communities we own right now. So we own right now about 56 communities, I believe, for again about 9,000 apartments. Again, this is a map that shows where they're located. Again, you can see those better in your brochures that you have. But mainly throughout the Southeast. Our most active state is Georgia. So how we mitigate risk in this strategy is first, as George also said, is our strong in-house management. So we do the vast majority of all of our management in-house. We do our asset management in-house. We have a big team who leads the results. These are some of the smiling faces who drive the results in our property management side. We have 150 team members just in our property management and construction management side of our business, driving results throughout our portfolio. Another big way we mitigate risk is through disciplined buying. So one of the biggest challenges in investing in almost anything today, but certainly investing in real estate, is pricing is really high. And if you were to go out there today and try to buy an apartment community, you're going to find really low cap rates, or in other words, really high valuations. So we really focus on buying properties at discounted prices. I believe you make money when you buy something. So we really focus on buying at really good prices. Another way we focus on mitigating risk is through long-term non-recourse debt. So we make a loan or we buy a property, we're typically putting on a loan on that property fixed in for 10 to 12 years, meaning our interest rate can't go up for the next 10 to 12 years, and typically the loan has a 30-year term to it. So meaning the loan length of the loan is 30 years, but the interest rate's fixed for the first 10 or 12 years. And those loans are non-recourse, meaning the lender can't come after anybody individually. There's no personal liability to these loans. And on average, our loan to value is about 55%. So we use leverage or debt, but we use it conservatively. We spend a lot of time to find these deals. So I know I made it sound easy. Well, buy properties at less than they're worth. That sounds really easy, right? Why doesn't everybody just do that, right? Well, it takes a lot of work. So we look at hundreds and hundreds of deals every single month. We have a team of analysts, investment managers, and people out in the field underwriting deals, going out, walking the properties, building relationships, inspecting the properties, going to competing communities, going to the police stations, understanding the markets, the properties, the assets, etc. And after looking at hundreds of properties a month, we buy about one every month. It takes us hundreds and hundreds of hours to get the kind of deals we get, but when we get them, they're really good. Another way we're able to get really good deals and also generate really good returns is we buy properties that need work. So we don't typically find properties as much as we would like to that are generating great returns from day one. We have to come in there and do some work. So typically we're coming in there and doing a lot of heavy renovations. So here's a picture of a community that we came into recently. At the beginning, you see the pool was down, kind of dated kitchens. This is a nice community, but needed some work. And now we've come in there and you can see what the kitchens look like now and hard surface floors. Got the pool online, we don't have a picture there, bathrooms remodeled. And we'll come into a community like this and take the rents from $600 a month to $750, attract better tenants who stay, who pay their rent, and increase the value of the properties pretty dramatically. This is an example of a local property in Nazareth that we bought that was in really rough shape, gutted rooming house basically. And we came in there and turned it into this. It's on Belvedere Street in Nazareth. You've probably driven past it if you've been in Nazareth at any point in the last number of years. A really beautiful building in downtown Nazareth Borough. This is another property we own. This is called a Cardinal community. We own 11 apartment communities that look just like this one. We come in, they're often in really rough shape, as you can see on those pictures. And we come in and we turn them into this and come in there and renovate them. Again, hard surface floors, new lighting, fresh paint, fresh landscaping. Make them a really attractive place to live, attract really great people. Here's another one, really rough property in Georgia. We came into it, had 40 apartments that were completely gutted, hadn't been rented in over 10 years, and we came in there and renovated them all to look just like this. So these are the type of things we do through our construction management arm of our business. So why do we invest in multifamily? Why do we invest in rental housing? Rentership is going up. It's gone up every year for the past 10 years, and home ownership has gone down. We're becoming a renter society. I believe right now 61% of Americans are homeowners. I believe we'll see in the next 10 to 15 years us fall down to 50%, which we're already right now close to historic all-time low home ownership. So people want to rent. They want to rent partially because they're not starting their families till later in life. They're not getting married till later in life. But also people want more flexibility. People don't stay at their jobs as long. People don't stay in a location as long. They want more flexibility that rentership provides. We focus on investing in apartments mainly in the Southeast, because you probably know this, but that's where people are moving. People want to go where it's warm and where there's jobs. And there's great jobs, and there's great job growth, and there's great weather, and in turn, great population growth in the Southeast, which are big drivers in housing. We invest mainly in small markets, so we don't own anything in Atlanta. We don't own anything in Miami. We don't own anything in Philadelphia. We don't own anything in the bigger cities. We're mainly the smaller markets because there's less institutional competition and we get better returns. We invest in Class B, or in other words, not luxury apartments, because we can also get better returns. These are typically apartments built before the 2000s that don't have all the luxury amenities. Our average rent is $800 versus the average rent of a new community is $1,700. So our rents are much lower. We attract workforce housing, people who need to rent, which is most of America. So in the past 10 years, here's an interesting stat. If you've heard this before from me, don't give the answer. But take a guess, in the past decade, since the last real estate recession, the big downturn of 2008, how much rent has gone up in the past decade? Can you shout it out? 5% I heard, 25%, 50%, 7%, so about 55%. So meaning if an apartment was renting for $700 in 2008, it's now renting for $1,050 today. Who thinks income has gone up 55%? So for the bottom 75% of wage earners, income has not even gone up 5%. I'm not talking inflation adjusted, I'm talking gross incomes. So with that said, rents are going up, cost of housing is going up, incomes are not going up. People need places to live, and there's no new product being built. So in the last 10 years, rents have gone up 55%, incomes have not gone up, but every single property that's been built has been Class A. Luxury, $1,700 a month of rent versus $800 a month rent. People can't afford the product that's being built, but builders and developers can't build what people can afford. It's a major problem, but that's why we focus on the area where there's no new product and there's lots and lots of demand, and that's not going to change. It's going to continue to grow. We also invest in this market class because we know when the market correction happens, it's not if, it's when it happens, because people need a place to live, there's a lack of supply, and if anything, the people stretching their budget, living off credit cards today in a $1,700 a month apartment, when they lose their job or confidence comes out of the market or they can't keep living off a credit card, they're going to have to live somewhere, and they're going to go to an affordable apartment, which is going to keep the demand, occupancy, and rents very strong in this asset class. From 2006 to 2012, the largest real estate decline in history, where property values went down 30–40%, rents did not go down at all. In this Class B and Class C space, rents still went up while we went through the greatest recession in most of our lifetimes. So it's a very stable asset class. This is an example of a property we buy. We bought this property in August of this year, 300 apartments in Valdosta, Georgia. This is what the community looked like when we came in there. These were apartments built in the 70s and 80s. We bought this property for $38,000 per apartment, or $11 million. The rents were about $530 when we came to this community. We're going to increase the average rent to about $675, and we'll produce a 23.7% average annual return is our projection on this investment, with producing double-digit cash-on-cash returns each year. So we'll come into this property and improve the quality of the units, do some cleanup on the exterior of the property. We'll spend about $2 million. There's about 20 apartments that were unrentable when we bought it. These are what the apartments, the units look like. They're nice, they're clean. We'll go in there and improve the quality of the units, drive up the rents, and improve the quality of our tenant base as well. So to invest in that strategy, the fund we have available today is our third equity fund. It's called the Preferred Return Equity Fund. In this fund, you're going to receive an 8 to a 9% return paid out quarterly from rental income. At the end of the fund, which is 5 or 6, 7 years from now, you'll return back 150 to 200% of your original investment, plus that 8 or 9% return you earned each year, for a total return of over 12%, likely mid-teen type return on an annual basis, with all that income we're paying out to you throughout the investment, majority of being deferred from tax through depreciation. So I know what you're thinking, wow, how do I get started? So if there's interest here, we do not have any checkbooks or paperwork with us today, or we're not expecting you to have a checkbook. We're simply going to be here to answer questions, schedule one-on-ones, and also, again, guide you to DLP Crowd to learn more. But before we wrap up here, we're going to be doing a couple more things yet. Again, reminder to go to dlpcrowd.com to learn more. We'll send you a link if you haven't been on there already. I want to tell you about a couple upcoming events that I'm going to hold you for a second before I let you get up and get a drink and open it up to questions. So our next event, if you want to get out of the cold, you can come down to Florida on January 17th and join us in St. Augustine, Florida, in the neighborhood I live in, where our company Southeast headquarters is located, and join us, which many of our investors have done. And we'll put you up in one of our properties in St. Augustine. You can turn it into a great weekend. And then we also have an event coming up called the DLP Inner Circle event. This is our second ever event we've done like this. It's going to be January 25th to the 27th, so just a few weeks away. These are some pictures from the first event we did back in May. Yeah, you see your pictures there. So we did this back in May, we did our first time. I'm going to bring up one of the investors in a minute who was at the event to tell you a little bit about it. So this is an event for our Inner Circle members. So what an Inner Circle member is an investor who hits one of two qualifications. The investor either has $1 million invested with DLP or has referred 3 investors to us. Any of those, either of those two ways qualifies you to be a part of the Inner Circle group. If you're not a part of it today, but you'd like to come join us at the event or be a part of the group, reach out to us and we'll talk to you about getting you to be able to still come attend this event, how you can qualify, how we can get you a part of this and come have a great time with us. We have right now, I believe, 25 couples joining us. We have room for 6 or 7 more rooms yet. We own an oceanfront condo building, which we're kind of standing at right there, with 24 luxury condos on the ocean that we own. And then we have another sister property next door with 16 more oceanfront condos. And that picture is actually at the oceanfront restaurant that we held some of our event at. So we have a few rooms left. We'd love to bring a few more investors to come out and join us. Have an amazing time. It's a really, really cool historical town, St. Simon's Island. Georgia, the Golden Isles is what some people call it. Sea Island, Georgia is right next to it if you've ever been there. So I'm going to play a quick little video from the event we did in May, which I don't think most of our investors have seen who were there. And then I'm going to invite up Helen to tell you a little bit about her experience there. Then I'll open it up to questions right after that. We've never done this, so let's hope it works. Don't stand there. So Helen, come on up. So that was our little recap of the presentation. It was an awesome, awesome time. And so we decided we're going to do the same thing again and go back there. And many of the same investors are going to be joining us again. And one of the investors who joined us at the event is here to join me tonight. Let me grab this over.
Happy New Year to everybody. And I did go to that event last spring or summer.
May, yep.
Okay. It was a wonderful event. It's a nice resort that DLP owns, and they put you up in beautiful accommodations, and you get all the meals, and they take you around to various historical places and golf courses and so forth. So hopefully that will inspire some of you to become Inner Circle members.
Awesome, thank you. So, at the event, we did some pretty cool things. What was your favorite part of the event?
My favorite part of the event was just experiencing some sunshine after a long winter in the Northeast. So that some of you can relate to that. In a month or two, you'll be happy to know that that could be part of your future. They actually paid my way there, and they limoed me from the airport to the resort, and I had a very nice time there with everybody.
Awesome, and you happened to invite a guest to join you at the event?
I did. I invited a guest who, believe it or not, was a student of mine maybe 35 or so years ago. And she now lives in Florida and has done very well for herself in a variety of real estate ventures. And they paid her way to come to the event as well. So I think it's a very worthwhile thing.
Awesome. So I'm going to put you on the spot for one more question. So you've been an investor with us for how long now?
I'm thinking maybe 4 years.
About 4 years. And which funds are you in?
I'm in the lending fund, and I have private funds in that, which I take the proceeds from each month and play with and live on and consider investing. And I also have a healthy account that's in a self-directed Roth IRA that I just allow to roll over, so the wonders of compound interest are great in that area, and I never have to pay 1 cent of tax. And I might say that it is true that they have never missed a payment or been late on one or anything else that would tend to worry people as an investor.
Awesome. And last question, somebody here, same question as George, somebody here thinking about investing with us, what would you tell them?
Oh, I tell them you can't do it too soon. I don't know about all the other funds as an individual investor, but I have, in fact, had several of my investor buddies come here and there in various funds, and each of them has had the same report that they've never missed a payment or been late on anything. So it beats the stock market. When I was driving up here from Philadelphia today and I heard this plunk that went 600 points down on the Dow, I thought, I don't care. Make any difference to my life. But those other people go plunk, and I kind of shrugged and came to my dinner.
Awesome. Thank you very much. Round of applause. So last plug I'm going to make for the event is something Helen did, is that not only can you come to the event, but you can bring a friend or a family member who could be a potential investor for us. And not only do we pay for their accommodations as well, and you pay for nothing, we also pay for your airfare and theirs as well to really make it no cost. A great opportunity to not only bring a guest and get them to take advantage of what we do, but also get to spend some time with a loved one or a close friend. So hopefully you'll reach out to us. Literally, this is not a sales pitch. We literally have 5 or 6 rooms left as of yesterday when the last investor booked, the most recent one booked. So we got a few rooms left to fill. So please reach out to us if interested in joining. I promise you'll have an amazing time. What we're doing better this time than last time is we're doing this event in January instead of May, when it's even better to be in 70-degree weather in St. Simons. So we're going to do a raffle right now, and then I'm going to open it up to questions. You ready for this? Oh, so they're going to come around and collect the raffles now. So while we go around and collect the raffles, I'll go ahead and start answering questions. So Brian here will come around with the mic. Simply raise your hand, and Brian will come over to you, answer your questions, then I'll do the raffle after questions. So who's going to be our brave first person with the first question?
John, were you guaranteeing 70-degree weather?
That's a good question. I'd say the odds are very, very good, but that is one thing I can't guarantee.
Okay, our question is, what is the minimum investment you can give you?
A great question. So short answer, in general, the minimum investment is $100,000. We have bent from that rule for families and friends of investors. So we gladly talk to you about that. But in general, the minimum investment is $100,000. But we worked with family, friends, and that's another interesting thing is many of the investors in this room, we have their children and their grandchildren's money invested in our various investments as well, which we've bent that rule for many times. Great question. Thank you. I got one over here.
Maybe one of the things you want to mention is that the reason I joined your company is because you have a national auditing company.
Comment he made was to mention the fact that we use a third-party auditing firm who evaluates us, which is a firm here called Bucknell Lasicki that many of you know, who are headquartered out of Allentown, regional, really great accounting firm, does our third-party audits on all of our funds and verifies all of our returns and the financials we produce. Thank you, Jim.
Hey, Don, we have a question from the YouTube live stream.
Oh, so I forgot to tell everybody here is famous. You're being streamed on YouTube and Facebook right now as we've been streaming this event. So we have investors all over the country dialed in. Go ahead, Brian.
Yeah, so from the YouTube live stream, someone wants to know, where does our deal flow come from to achieve the goals that we have set?
So the question is, where does our deal flow come from? So we have a team of people out sourcing deals, out building relationship with brokers and sellers. We do a lot of marketing as well. Actually, Brian runs our marketing agency. We do a lot of marketing to attract deals as well. And we have a team of about 14 salespeople out in the field building relationship with borrowers and sourcing deals regularly. So we have a really big deal volume, and when you build a reputation with sellers and brokers that you close, you come up with the money, you're easy to deal with, they keep bringing more and more deals to you.
You're done. You're done. So, what happens to all of this if you die tonight?
So I'll phrase the question in a softer way. So if I get hit by the proverbial bus, what happens? Yeah, it's a great question. So the short answer is, our team has the ability to easily manage everything. So we have, I guess to cover a couple of specifics, we have large life insurance policies with the company as a beneficiary to provide significant liquidity, number one. Key man policies. And then Bob, our CFO, is set up as essentially as operating trustee to handle the wind down of all the assets and selling off the property. So the reality, without me, the company doesn't continue to grow. We don't keep buying properties, but the company can easily manage the assets and work through an orderly liquidation of the properties. The loans pay off quickly already. And interesting enough, our CFO, Bob, who's been with us now for, I believe, 4.5 years, he was at his previous firm for 37 years. And at his previous firm, they had about $4 billion in real estate. And the owner did get hit by the proverbial bus. He was an older gentleman. And Bob handled the wind down of all those assets for the family. And actually, the family are now investors of ours. But he actually went through that process and actually did it very successfully, to the point that the heirs of that family are all investors of ours today. So great question.
What's Bob's last name?
Bob Peterson is our CFO. Other questions? I know that cake looks good. Everybody's busy with that. How are you?
So the question is, I see that you're planning for the market correction, right? Looking at investing in Class B, makes a lot of sense. Do you have any other investing strategies that you're going to be employing with that market correction?
Great question. So question or comment was that we're focusing on the market downturn in some of our investment strategies. So example that I covered was we focus on Class B apartments that we think are going to do really well through a market correction. The other thing we really focus on that we think puts us in a great position for a market correction is our lending strategy, because we're not making long-term loans. So if we made a 5-year loan or a 10-year loan, now you're stuck in a situation where the collateral value could be going down if property value is dropping, and you could end up in an upside-down situation. We're not exposed to that. We have 46% equity on average above our loan amount. Real estate has never gone down more than 10% in a year, and our loans are mainly 6 months. So we have a lot of protection there. But to answer the question maybe a little bit more detail is, we're really preparing, becoming more liquid, and that means putting more money into our lending strategy that's more liquid. Same for us as it is for you, that it provides great liquidity, because we know when the market does turn, unfortunately for many, there's going to be a lot of distress, and we want to be ready to capitalize on that. So we expect actually when the market does turn that we'll actually be increasing our buying and our investing activity dramatically. The only variable to that is all of you. So our job right now is to build your trust and confidence that we're going to be able to not only weather a downturn, but capitalize on a downturn, so that you want to not only keep your money with us, but invest potentially more of your capital with us, so that we can capitalize on those distressed opportunities. So even though right now, example, we're not building a single-family rental portfolio, we did that in the last downturn. We bought lots of single-family rentals, and now we're selling those now at the top of the market. So when the market turns again, we may buy a lot more single-family homes as rentals again and do the same thing. In the last downturn, we bought lots of almost 100% vacant office buildings, and we leased them up, and we've been exiting those office buildings now. So those are the types of things that made sense for us to do when the prices were really low, that don't make sense today, but will make sense again, very likely, when the market turns. Those are a couple examples. So great question. All right, we got a live one here, and then I'll come to you, Kyle. Yes.
What are the current market rates?
The rents? So the average rent when we came into that, is that what you're asking, rents?
It was $550 before.
Yeah, so the average rent, so we only bought that property about 3 months ago. So the average rent when we bought it was, I think, $527 or $37. The new leases we've been signing already have been about $650, and we think we'll be at about $700, by middle of this year.
So at what point would DLP get out of it?
So we model our investments that we're going to own them typically for 5 to 7 years, which is also the length of the fund. So some properties we may hold longer. We look at them, we want them to be good long-term investments, but we model them that we're going to own them through a market cycle, so 5 to 7 years. But with that said, it's something we talked about a little bit earlier at the happy hour for our existing investors. A lot of the properties we bought in the last 3 or 4 years, we did expect to own longer. We're going to sell this year. So this year we're going to be selling over 20 of our apartment communities for 2,500 to 3,000 apartments. And that's because the values are even greater than we projected, and we know we can exit those properties today at a greater price than we're probably going to be able to exit them for the next 5 or so years. So we're capitalizing on that today, getting the money more liquid to be ready to capitalize on the next distressed opportunities. A great question.
Another question from the YouTube live stream. The question is, do you have, or does DLP have any institutional investors? And if so, what percentage of our total funds are institutional investors?
So question, if you didn't hear that, is do we have institutional investors? And if so, what percentage? So short answer is sort of. The longer answer is we have a number of RIA firms, wealth management firms, financial advisors who invest with us. But predominantly what they're doing is simply bringing us investors just like you. So they're taking our investment strategies out to their clients and saying, hey, I have this great investment strategy, and then they're allocating their clients' money. So the money comes to us just like your money comes to us from an individual's name and an individual's account, but the relationship comes to us through an institution. We do have a couple small investment funds that invest with us. We have a few family offices, which are that just means very wealthy families. We have a couple small pension funds, which are mainly really family-run pension funds. So 99+ % of our investors are really just accredited and wealthy families that are invested with us. Any other questions in here? I'll get this one, Brian. I'm sorry.
Why is it necessary to be accredited as an investor with you?
Great question. So his question was, why do you have to be an accredited investor to invest in our funds? So the answer is because of the government. Blame the government. But in all seriousness, it's the Securities and Exchange Commission. So the Securities and Exchange Commission regulates that for private investment offerings, investors have to be accredited. And the definition of accreditation is you have $1 million in total net worth, not including the home you live in, or a $200,000 annual income. If you do not meet those requirements, we may be able to work with you on our fixed notes. We have many investors who are not accredited investors who invest in our fixed notes with us, which are those fixed returns I showed earlier. But in our investment funds, you must be accredited, and that's due to the SEC. But great question. Yes, sir.
This one actually goes right along with that, so it's perfect. If you aren't an accredited investor, what is the best way to invest, and is there a minimum?
So the question was, if you're not an accredited investor, how can you invest and what's the minimum? And the answer is our fixed notes is really the only option, and it's a fixed return of 6 to 9%. We just ran an incentive recently. We're paying upwards of 10%, and the minimum investment typically is $100,000. And again, that can be IRA money. That can be a mix of, two separate accounts: a cash account, an IRA account, a husband's account, a wife's account. We can break it up a lot of different ways. Thank you. No?
Yes, question. Is the accreditation, is that some kind of formal procedure you go through, or is it just what you are automatically just on virtual having those funds?
Great question. So how do we verify somebody's accredited? So the simplest way we do it is you get your accountant, your financial advisor, your CPA, your attorney to give you, and we can give you a sample form that they simply say in a couple sentences that they believe you're an accredited investor, that they believe you meet the requirements of accreditation. So we can give you the form, you get your advisor to sign it. That's all we need. If you don't have an advisor who can do that for you, we can potentially refer you to one, but also the other options are you can provide us with account statements showing you have the net worth requirements. We can go through a personal financial statement process. So a couple alternatives we can do if you don't have it in an easy way to have an advisor who can do it for you. But the advisor route is the easiest for us. It's the easiest for you if you have that advisor who can do it. If you don't, we can go through a couple other ways. So unfortunately, to answer the question specifically, the SEC does require us to go through a verification process, which there's a few different ways we can do that. And it's a pretty painless process.
So the short-term profits get distributed every month, right? What happens to the long-term appreciation?
So a question is relating to our preferred return equity fund, the multifamily strategy. So we pay out, historically in these funds, our third of these funds, we pay out an 8 to 9% return, annual return, paid out quarterly. So in other words, if you invest 100 grand, you're getting around 2 grand every quarter. Most of that income deferred from tax. And then at the end of the fund, we're going to return back to you once we sell the properties. We're going to return back to you. Our targets to return back, depending on how long the fund goes, around a 1.5 to 2 times your original investment. And that money will come back to you, and you can then take that money and reinvest into another strategy with us, another opportunity to take the money back. Good.
So what if we are already cashed out midway?
So question is, what if you're cashed out midway? So in this fund, it's a 5 to 8 year fund. So you're going into the fund with a duration expectation of being invested for 5 to 8 years. Most of these types of funds, there's no way out. With our fund, we do have a way that if you do need to get out of the fund for a good reason or not, midway through the fund, we have a 180-day redemption period. You can request early redemption. We don't charge fees or penalties, and we'll make our best faith effort to get you redeemed. We have had that happen a handful of times over the years in our equity funds. We've typically redeemed out in the matter of a month or 2 or less. So we're able to create liquidity for you in a lot of different ways we do that. But you don't want to go into the strategy unless you're looking at it at a long-term basis. But if something happens, you need to get out, we have ways to create that liquidity for you. It's a great question. You got it?
First off, thank you for your hospitality. It's outstanding. Appreciate it. I was raised by a father who said it sounds stupid to run. And so I don't know a lot of people making these kind of returns, which is fantastic. And I'm speaking with people at our table who love it. And so they're great salespeople for you. I noticed on one of the slides that a large percentage of the people that are investing are less under a year or a year plus. It looked like about 3/4 of that number, and I might have read that wrong because the slide went by pretty quick. Is there a lot of churn? Are you leaving people after a year or so that come out of it? What kind of return comes through? And is the returns dependent on the next person investing, or are they built into the fabric of the
Great, yeah, great questions. So I'll tackle those a bit in order. I'll try. So right now, this past year, we brought in 135 new investors who invested with us in 2018, bringing us to over 500 investors. The existing investors who were with us at the start of the year made over 300 investments with us in 2018. In 2018, we had over $85 million in capital invested with us, and out of money that actually left us, meaning it didn't just go from one investment fund to another with us, was under $2 million. I don't think we're at $5 million in total redemptions since we started. So virtually every investor is with us today. As far as I know, I only have one investor who's ever invested with us who's not with us today. So we have very, very little churn. So yes, we have a lot of investors only on 1 year, 135 of them, because we're steadily growing momentum and the word's getting out, and we're bringing in lots of new investors. But we have very little churn. People stay with us. And no, returns have nothing to do with new investors coming in. All of our returns, so example, our lending fund, income and growth fund, 100% of our return is driven by interest income. The financials are very simple. There's no unrealized returns. When we say we generate a 14% return, that's not, well, we generated 6% income and we reevaluated the portfolio and that's where the other came from. It's based on us increasing the value. Which if you didn't know this, and most REITs and so forth, that's what they do. They do an updated valuation of their portfolio every day or every month or every quarter, and they say, oh, real estate values went up, so your returns went up. Did they actually go up? No, but the underlying asset values did. 100% of the returns we generate are generated, distributed income. In our preferred return equity fund, our multifamily strategy, 100% of the income we're paying out each quarter is coming from income derived from renting the apartments, from rental income. And then when we sell the properties, we're generating income from profits from the sale. But it's all 100%. We don't go in and reevaluate our portfolio or drive any of the valuations or any of the returns from an increase of value or new capital coming in or anything to that effect. So great questions. Oh, back here.
Thank you. I'm currently within the lending fund, and it's through my IRA. And I'm thinking of doing a health savings account, which the family contribution is just under $7,000. So how could I put that together what would be the minimum share amount or the minimum deposit amount? What does DLP require on that?
So I have to confirm for you, but we have never taken in a health savings account or anything to that effect. I don't think we could take in that investment class, but I'd have to get back to confirm that. We have not had that question. We've not evaluated that, so it could be possible, but I'd have to get back to confirm that if that be a type of qualified investment structure we could take in.
It's with the same IRA custodian.
Okay, it is, okay.
Yeah.
So I can check on it. We haven't had that question or evaluated that, so it very likely could be possible that we could take that in just like any other IRA type investment, but we haven't come across that yet, so I'd have to confirm that for you. So I can follow up with you on that next week.
Sure.
Cool.
Y'all heard from me before with the block on the investments in the stock market, but I do have another question. When you continue to buy the larger apartment complexes around the southeast part of the United States, what do you project as your next investment entity for people in this room and general investment group that you have?
So the current fund right now is the Preferred Return Equity Fund, which is our third ever of these funds. We got creative here. Our first two were called the Equity Fund 1 and the Equity Fund 2. This one's called the Preferred Return Equity Fund. Partly we wanted to make it sound a little better, but it's also one of the unique things about it that I didn't mention is every investment we make is in preferred equity, meaning there's equity invested behind the fund, sheltering the fund, which is a really cool risk mitigant that I didn't cover. But to answer your question, that's where nearly all of our multifamily investments go. If that fund has the capital to invest, it gets every deal we buy. When the fund doesn't have enough money to handle a larger deal, I either put in the rest of the money or every now and then we'll open the opportunity up to other investors. We haven't done that in quite some time to invest outside the fund. So right now and for the next, for 2019, that'll be the vehicle. Potentially in 2020, we'll open another fund, as we only keep these funds open for a certain amount of time to invest into the ones that buy real estate so that they can wind down in a certain period of time. So we can't keep buying properties forever because then we won't be able to wind down the fund and return capital. So this fund will be open for at least most of 2019 to invest into, and it currently owns somewhere around 2,000 apartments. And it'll probably buy another 1,500 or 2,000 before it closes.
Have we ever figured out how to get rid of the recaptured depreciation?
Short answer is no. Her question is, can you get rid of, has there been a way to get rid of recapture of depreciation, meaning when the property's sold, now you're going to have to pay long-term capital gains on that tax that you deferred over the course of time, which of course is much better than paying ordinary income throughout the investment. So the short answer is no. At some point you have to pay the man, but not necessarily at the end of the fund. So like in our Equity Fund 1, it's winding down right now, and we did create a vehicle for investors to roll into and defer tax for another 5 to 8 years. So we do expect we will create another vehicle that you won't get rid of ever paying it, but you'll defer paying it for another 5 to 8 years, as an example. You got it. Thank you. Any other questions? All right, so we're going to go ahead then. I'll answer any others come up, but we'll get the raffle going now. Oh, we got one here, and we'll get the raffle ready to roll.
Hi, Don. You're winding down the Equity Fund. What type of return can those investors expect?
So question was, since we're winding down the Equity Fund 1, what is the returns the investors can expect? The short answer is it's going to work out to be about a 20% annual return net to investors over the duration of the fund, which has been about a 5-year fund. It's our first of this type of fund. So that wind down is going to happen here this quarter. Investors will either take those distributions and then they can go into another fund with us or do anything they want with it, or we're giving this other vehicle that they can go into and defer tax for another 5+ years and not pay the man. Thank you. All right, which one is this? Current investors. So I need a prospective investor here. Prospective investors. I'm only seeing current investors here. There we go.
There goes, dig in.
All right. So the winner is Sue Scartelli. And I guess I should have told you what you're going to win. If maybe they told you. but I spent a couple minutes telling you about how wonderful St. Simon's Island is, and we have this amazing oceanfront condo building. You get to go stay in St. Simon's Island is what the winning prize is at no cost on us. So pretty cool prize, and hopefully Sue will take advantage of that shortly. Awesome, Sue. Round of applause again for Sue. Larry will come over and gather up your information then and get you everything over. Awesome, thank you. All right, now we're gonna pull for a prospective investor. So we need a current investor to go ahead and pull this. So Sue, do the honors.
Sue, pull my name. Do my best.
All right, what do we got here? Nancy Weichert. Nancy, there we go. Congrats, Nancy. We'll come over to you then, but congrats, you get a vacation in St. Simon's Island. Awesome. All right, everybody, so that's everything we have here. I'll be around, as will the rest of the team, to answer questions, or you can let our current investors answer them for you, as they know it nearly as well as I do, I think, at this point. But thank you, everybody. Appreciate your time tonight.